Question 1. Cost-benefit analysis shows that implementing a credit freeze can be a valuable tool for identity theft protection, but its effectiveness and implications require careful client consideration. An agent is approached by a client who is concerned about potential identity theft after receiving a suspicious email. The agent needs to advise the client on the best course of action. Which of the following approaches best aligns with regulatory requirements and ethical professional conduct for a CIC Personal Lines Institute exam candidate? Option A. Advise the client that credit freezes are generally not necessary for personal lines insurance clients and suggest they simply ignore suspicious emails. Option B. Immediately initiate the credit freeze process for the client, assuming that any protection is better than none, and address any questions the client may have afterward. Option C. Place a credit freeze on the client's behalf without detailed explanation, stating that it is a standard procedure for identity theft concerns. Option D. Fully explain the process of placing a credit freeze, its duration, how to temporarily lift it for legitimate credit applications, and confirm the client's understanding and explicit consent before proceeding. The correct answer is D. Fully explain the process of placing a credit freeze, its duration, how to temporarily lift it for legitimate credit applications, and confirm the client's understanding and explicit consent before proceeding. Explanation. This scenario is professionally challenging because it requires balancing the client's immediate desire for a quick resolution with the agent's responsibility to ensure the client understands the long-term implications and legal requirements of their actions regarding credit freezes. The agent must not only explain the process, but also the potential consequences and the client's rights and obligations under relevant regulations. The correct approach involves thoroughly explaining the implications of a credit freeze to the client, including its purpose, duration, and the process for lifting it, while also confirming the client's understanding and consent. This aligns with the ethical duty of care and the regulatory requirement to provide accurate and complete information to clients. Specifically, under the CIC Personal Lines Institute exam framework, agents are expected to act in the best interest of the client, which includes ensuring informed consent and understanding of financial protection measures. This approach prioritizes client education and empowerment, preventing potential misunderstandings or regrets later. An incorrect approach that focuses solely on the mechanics of placing a freeze without discussing its implications fails to meet the duty of care. This could lead to a client misunderstanding the freeze purpose or duration, potentially causing them to believe their credit is permanently protected or that they cannot access credit when needed, which is a regulatory and ethical failure. Another incorrect approach that involves pressuring the client to place a freeze without adequate explanation or considering their specific circumstances is also professionally unacceptable. This violates the principle of informed consent and could be seen as misrepresentation or undue influence, leading to regulatory scrutiny and damage to the client's financial well-being. Finally, an approach that dismisses the client's concerns about credit security and fails to offer appropriate solutions like a credit freeze, even when it might be a suitable option, is a failure to act in the client's best interest. This demonstrates a lack of diligence and could result in the client being exposed to unnecessary risk, which is a breach of professional standards. Professionals should approach such situations by first actively listening to the client's concerns to understand their specific needs and anxieties. Then, they should clearly explain the available options, such as credit freezes, detailing their benefits, limitations, and the procedural aspects. Crucially, they must confirm the client's comprehension and obtain explicit consent before proceeding, ensuring the client makes an informed decision. Question 2. Assessment of an applicant's eligibility for a homeowner's insurance policy requires careful consideration of various property-specific factors. Which of the following approaches best reflects the professional and regulatory requirements for determining eligibility for a homeowner's policy under the CIC Personal Lines Institute exam framework? Option A. Relying on general industry knowledge of homeowners' insurance eligibility without consulting the specific insurer's underwriting manual or state statutes. Option B. Proceeding with coverage placement if the applicant states the property is in good condition and has no known major issues, assuming standard eligibility. Option C. Prioritizing the speed of policy issuance over a detailed review of property characteristics to ensure the applicant obtains coverage promptly. Option D. Verifying the property's construction type, age, condition, and location against the specific underwriting guidelines of the intended insurer and any applicable state regulations. Correct answer is D. Verifying the property's construction type, age, condition, and location against the specific underwriting guidelines of the intended insurer and any applicable state regulations. Explanation. This scenario is professionally challenging because determining eligibility for personal lines insurance, particularly for homeowners' policies, requires a nuanced understanding of how various factors can impact insurability according to specific state regulations and underwriting guidelines. Agents must balance the applicant's need for coverage with the insurer's risk appetite and regulatory compliance. Careful judgment is required to avoid misrepresenting eligibility or placing coverage with an insurer that cannot legally or practically provide it. The correct approach involves a thorough review of the property's characteristics against the insurer's established underwriting guidelines and relevant state statutes. This includes verifying the property's location, construction type, age, condition, and any potential hazards that might render it ineligible. This approach is correct because it directly aligns with the CIC Personal Lines Institute exams focus on adhering to regulatory frameworks and insurer-specific eligibility criteria. By meticulously checking these factors, the agent ensures compliance with underwriting rules designed to maintain the insurer's solvency and adhere to state insurance department mandates regarding acceptable risks. This proactive verification prevents the issuance of policies that could be later canceled or non-renewed due to ineligibility, thereby protecting both the consumer and the insurer. An incorrect approach would be to assume eligibility based on a general understanding of homeowners insurance, without verifying specific property details against the insurer's guidelines. This fails to account for unique property risks or specific state regulations that might deem the property uninsurable by that particular carrier. Another incorrect approach would be to prioritize securing coverage quickly over accurately assessing eligibility, potentially leading to the placement of a policy that is not sustainable or compliant. This disregards the agent's fiduciary duty to both the client and the insurer. A third incorrect approach would be to rely solely on the applicant's self-reported information without independent verification of critical eligibility factors, such as the presence of certain protective devices or the condition of the roof, which are often explicitly addressed in underwriting manuals. This overlooks the responsibility to ensure the accuracy of information used for underwriting. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the specific insurer's underwriting appetite and the applicable state regulations. This involves actively seeking out and reviewing underwriting manuals, state-specific endorsements, and any other relevant guidelines. When presented with an application, the agent should systematically cross-reference the property's characteristics with these established criteria. If any doubt arises regarding eligibility, the agent should consult with the underwriter or seek clarification before proceeding. This methodical and informed approach ensures that all eligibility requirements are met, leading to appropriate coverage placement and fostering long-term client satisfaction and regulatory compliance. Question 3. Upon reviewing an application for homeowners insurance, the agent presents the applicant with a policy proposal detailing specific coverage limits and a $1,000 deductible. The applicant responds by stating, "I accept this offer, but I would prefer a $500 deductible instead." Which of the following best describes the legal status of the applicant's response in relation to the original policy proposal? Option A. The applicant's response is a clarification of the original offer, and the insurer is obligated to accept it. Option B. The applicant's response is an inquiry about potential endorsements, and the original offer remains open. Option C. The applicant's response is a counteroffer, rejecting the original proposal and creating a new offer from the applicant. Option D. The applicant's response constitutes a valid acceptance, creating a binding contract with the original terms. Correct answer is D. The applicant's response constitutes a valid acceptance, creating a binding contract with the original terms. Explanation. This scenario presents a professional challenge because it requires an insurance agent to distinguish between a valid offer and a preliminary negotiation, and to understand the implications of an acceptance that deviates from the original offer. Misinterpreting these contract law principles can lead to significant legal and ethical breaches, potentially resulting in a binding contract that was not intended by the insurer or the applicant, and exposing the agent and the agency to liability. Careful judgment is required to ensure all elements of a valid contract are present before confirming coverage. The correct approach involves recognizing that the applicant's response, which includes a request for a different deductible amount, constitutes a counteroffer rather than a clear acceptance of the original offer. A counteroffer effectively rejects the initial offer and creates a new offer from the applicant. The agent's responsibility is to then present this counteroffer to the insurer for their consideration. This aligns with the fundamental contract law principle that acceptance must mirror the offer. Any deviation, such as a change in terms like the deductible, transforms the acceptance into a counteroffer. This approach upholds the principle of mutual assent, ensuring that both parties agree to the exact same terms before a contract is formed. Ethically and regulatorily, an agent must not assume acceptance or bind the insurer to terms that have not been explicitly approved. An incorrect approach would be to consider the applicant's response as a valid acceptance and proceed as if coverage is in place. This fails to acknowledge that the change in the deductible amount fundamentally alters the terms of the proposed insurance policy. By treating it as an acceptance, the agent would be misrepresenting the status of the application and potentially creating a contract based on terms that the insurer has not agreed to. This violates the principle of legal purpose, as it attempts to form a contract under false pretenses. It also breaches the duty of good faith and fair dealing owed to both the applicant and the insurer. Another incorrect approach would be to advise the applicant that their request for a different deductible is irrelevant and that the original offer is still valid and accepted. This demonstrates a misunderstanding of offer and acceptance. A counteroffer, by its nature, terminates the original offer. The agent's role is to accurately advise the client on the legal implications of their actions within the contract formation process, not to dismiss or misrepresent the effect of a counteroffer. This approach would mislead the applicant and could lead to disputes when the insurer later rejects the policy with the altered deductible. Finally, an incorrect approach would be to simply ignore the applicant's request for a different deductible and proceed with issuing the policy as originally quoted. This is a failure to communicate and to ensure mutual assent. The applicant's request, even if it deviates from the initial offer, is a material term that requires acknowledgement and agreement from both parties. Ignoring it means the applicant's expressed desires are not being addressed, and the insurer is being presented with a policy that may not reflect the applicant's true intentions or the insurer's underwriting guidelines for that specific risk profile. This breaches the agent's duty to act in the client's best interest and to accurately represent the terms of the insurance. The professional decision-making process for similar situations involves a systematic evaluation of the communication received. First, identify the original offer. Second, analyze the response to determine if it is an unqualified acceptance or a modification. If it is a modification, recognize it as a counteroffer. Third, communicate the counteroffer to the insurer for their decision. Fourth, clearly explain to the applicant the status of their offer and the implications of the counteroffer. This methodical approach ensures adherence to contract law principles and regulatory requirements, protecting all parties involved. Question 4. Stakeholder feedback indicates a need to clarify the application of the Terrorism Risk Insurance Act, TRIA, within personal lines insurance. Which of the following best describes the correct approach for an insurance professional to ensure compliance and proper policyholder communication regarding terrorism risk? Option A. Focus on TRIA compliance only when a specific act of terrorism has been declared a certified act by the government. Option B. Review all personal lines property policies to determine if they are subject to TRIA federal backfill program and ensure policyholders receive the mandated notice regarding terrorism coverage and exclusions. Option C. Assume TRIA only applies to commercial lines policies, and therefore no specific disclosure is required for personal lines property policies. Option D. Include a blanket exclusion for all acts of terrorism in all personal lines policies, without providing any specific notice to the policyholder about TRIA. The correct answer is B. Review all personal lines property policies to determine if they are subject to TRIA federal backfill program, and ensure policyholders receive the mandated notice regarding terrorism coverage and exclusions. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complexities of federal legislation impacting personal lines insurance, specifically the Terrorism Risk Insurance Act, TRIA. The challenge lies in accurately identifying the scope and application of TRIA to various policy types and understanding the reporting and disclosure obligations it imposes. Misinterpreting these requirements can lead to noncompliance, potential financial penalties for the insurer, and a failure to adequately inform policyholders about coverage limitations. Careful judgment is required to ensure that all applicable policies are correctly identified and that the necessary disclosures are made in accordance with TRIA. The correct approach involves a thorough understanding of TRIA definition of certified act of terrorism and its application to commercial lines policies, as well as the specific exclusions and limitations it places on terrorism coverage. This approach necessitates reviewing policy forms and endorsements to determine if they are subject to TRIA and ensuring that policyholders receive the required notice regarding terrorism coverage. This aligns with the regulatory framework by ensuring compliance with federal law, which mandates specific disclosures and outlines the conditions under which federal backfill is available for terrorism losses. By accurately applying TRIA, professionals uphold their duty to both the insurer and the policyholder, ensuring transparency and proper coverage. An incorrect approach would be to assume TRIA applies to all property insurance policies without a detailed review. This fails to recognize that TRIA's primary focus is on commercial lines and that personal lines policies may have different treatment or exclusions related to terrorism. This oversight could lead to incorrect premium calculations, improper disclosures to policyholders, and a misunderstanding of the insurer's actual exposure and coverage obligations. Another incorrect approach would be to ignore the disclosure requirements of TRIA altogether, believing that the absence of specific terrorism coverage in a policy negates the need for notification. This is a regulatory failure because TRIA mandates that policyholders be informed about the extent of terrorism coverage, including any limitations or exclusions, regardless of whether the policy is subject to the federal backfill program. A third incorrect approach would be to only consider TRIA when a specific act of terrorism has occurred. This reactive stance misses the proactive compliance requirements of the Act, which include ongoing obligations for insurers to understand and implement TRIA provisions in their policy offerings and disclosures. Professionals should employ a decision-making framework that prioritizes understanding the specific regulatory requirements of TRIA, including its applicability to different lines of insurance and its disclosure mandates. This involves continuous education on relevant legislation, meticulous review of policy forms and endorsements, and clear communication with policyholders. When faced with uncertainty, consulting with legal counsel or regulatory compliance experts is a crucial step in ensuring adherence to the law and ethical practice. Question 5. Performance analysis shows that a client is requesting to exclude flood coverage from their homeowner's policy to lower the premium, stating they believe their property is not at risk. The agent knows the property is located in a moderate flood risk zone according to FEMA maps, which would significantly impact the availability and cost of flood insurance. What is the most ethically and regulatorily sound approach for the agent? Option A. Explain to the client that while flood insurance is optional, their property's designation in a moderate flood risk zone means that flood damage is a potential risk, and that flood insurance is available and recommended to protect against such losses, detailing the potential costs and benefits. Option B. Advise the client that flood insurance is generally not necessary for homeowners' policies unless they are in a high-risk zone, and proceed with excluding it to meet their premium reduction goal. Option C. Inform the client that flood insurance is a separate policy and not part of the homeowner's policy, and therefore can be excluded without further discussion. Option D. Agree to exclude flood coverage as requested by the client to secure the sale and maintain client satisfaction, assuming the client is knowledgeable about their own risk tolerance. The correct answer is A. Explain to the client that while flood insurance is optional, their property's designation in a moderate flood risk zone means that flood damage is a potential risk, and that flood insurance is available and recommended to protect against such losses, detailing the potential costs and benefits. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance the client's immediate desire for a lower premium with the agent's ethical and regulatory obligation to provide accurate and complete information regarding flood insurance. The agent must navigate the complexities of flood zone designations and their impact on coverage availability and cost, ensuring the client makes an informed decision. The correct approach involves proactively educating the client about the implications of their property's flood zone designation, even if it leads to a higher premium or the need for separate flood insurance. This aligns with the agent's fiduciary duty to act in the client's best interest and adhere to regulatory requirements that mandate fair and honest representation of policy terms and conditions. Specifically, regulations governing insurance sales emphasize the importance of full disclosure and avoiding misrepresentation or misleading statements. By explaining the flood zone status and its consequences, the agent upholds these principles, ensuring the client understands the risks and available coverage options, thereby preventing potential future claims disputes or E&O issues. An incorrect approach would be to downplay the significance of the flood zone designation, or to suggest that flood coverage is unnecessary or can be omitted to reduce the premium. This would be a misrepresentation of material facts, violating ethical standards and potentially breaching insurance regulations that prohibit deceptive sales practices. Another incorrect approach would be to simply accept the client's request to exclude flood coverage without a thorough explanation of the risks, which fails to meet the agent's duty of care and could lead to the client being underinsured. Failing to disclose the flood zone status and its implications is a direct violation of the duty to inform and could be construed as negligence or even fraud. Professionals should approach such situations by first understanding the client's needs and concerns. Then, they must access and accurately interpret relevant information, such as flood zone maps and policy details. The next step is to clearly and comprehensively communicate this information to the client, explaining the implications of their property's location and the available insurance options. This communication should be documented to demonstrate due diligence and to protect both the agent and the client. If a client insists on a course of action that appears detrimental or non-compliant, the agent should explain the risks and regulatory requirements, and if necessary, decline to proceed with the transaction if it compromises ethical or legal obligations. Question 6. Implementation of a personal umbrella policy recommendation requires an insurance agent to assess a client's unique risk profile and financial situation. A client expresses a strong preference for the lowest possible premium for their personal umbrella policy. Which of the following approaches best aligns with the agent's professional responsibilities and regulatory expectations for this exam? Option A. Provide quotes for several coverage limits, clearly explaining the premium differences and the rationale for higher limits based on potential liability exposure and asset protection. Option B. Immediately recommend the highest available coverage limit, regardless of the client's stated premium preference, to ensure maximum protection. Option C. Advise the client that personal umbrella policies are optional and that the agent cannot provide recommendations beyond quoting the requested limit. Option D. Recommend the lowest available coverage limit to meet the client's stated premium preference without further discussion. The correct answer is D. Recommend the lowest available coverage limit to meet the client's stated premium preference without further discussion. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agent to balance the client's stated needs with the agent's professional responsibility to ensure adequate coverage. The client's desire for a low premium might lead them to underestimate their actual liability exposure, creating a potential gap in protection that the agent must address without alienating the client. The agent must navigate this by providing clear, informed advice grounded in regulatory expectations for suitability and client best interests. Correct approach analysis. The correct approach involves the agent actively discussing the client's assets, potential liabilities, and lifestyle to recommend a personal umbrella policy limit that aligns with their risk profile, even if it exceeds the client's initial, lower premium expectation. This is justified by regulatory frameworks that mandate agents act in the client's best interest and provide advice that is suitable for their circumstances. The CIC Personal Lines Institute exam emphasizes the agent's fiduciary duty to recommend coverage that adequately protects the insured, which includes educating them on potential risks and appropriate coverage levels. Failing to do so could be considered a violation of ethical standards and potentially regulatory requirements regarding due diligence and client advisement. Incorrect approaches analysis. recommending the lowest available limit solely based on the client's stated premium preference, without a thorough risk assessment, fails to meet the standard of care. This approach prioritizes premium over adequate protection, potentially exposing the client to significant financial loss and violating the principle of acting in the client's best interest. Another incorrect approach is simply providing a quote for the requested limit without any discussion of higher limits or underlying liability exposure. This abdicates the agent's responsibility to advise and educate, leaving the client uninformed about potential coverage shortfalls. Finally, pushing a higher limit aggressively without understanding the client's financial capacity or specific concerns could be seen as overselling and not truly acting in the client's best interest, though the primary failure in this scenario is underinsuring. Professional reasoning. Professionals should approach this situation by first understanding the client's stated objective, lower premium, and then layering on their professional obligation to assess risk and recommend suitable coverage. This involves active listening, asking probing questions about assets and potential liabilities, and clearly explaining the purpose and benefits of a personal umbrella policy at various coverage levels. The decision-making process should prioritize client education and informed consent, ensuring the client understands the trade-offs between premium cost and the level of financial protection. If a client insists on a lower limit than recommended, the agent should document the discussion, the recommendation made, and the client's decision, thereby demonstrating due diligence. Question 7. Which approach would be most appropriate for an insurance professional when determining what expenses are covered under a personal lines policy following a covered loss, ensuring compliance with the CIC Personal Lines Institute exams regulatory framework? Option A. Immediately approve all expenses the insured states are necessary for recovery, assuming the insurer will cover them. Option B. Delay payment on all expenses until the insured provides an exhaustive list of every single item, no matter how minor, that could possibly be related to the loss. Option C. Prioritize a thorough review of the policy's covered expenses section and compare it directly against the specific details of the loss and the insured's submitted documentation. Option D. Assume coverage for expenses based on how similar claims have been handled in the past, without a detailed review of the current policy. The correct answer is C. Prioritize a thorough review of the policy's covered expenses section and compare it directly against the specific details of the loss and the insured's submitted documentation. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the insured's immediate need for financial assistance with the insurer's obligation to adhere to policy terms and regulatory requirements regarding covered expenses. Misinterpreting or misapplying policy definitions can lead to financial hardship for the insured or regulatory noncompliance for the insurer. Careful judgment is required to ensure that all covered expenses are identified and paid promptly, while also respecting the policy's limitations and exclusions. The correct approach involves a thorough review of the policy's covered expenses section in conjunction with the specific circumstances of the loss. This approach prioritizes accurate interpretation of the policy contract and adherence to the CIC Personal Lines Institute exams regulatory framework. By focusing on what the policy explicitly defines as covered, the professional ensures that payments are made in accordance with the contract and applicable regulations, thereby protecting both the insured and the insurer from potential disputes and financial repercussions. This aligns with the ethical duty to act with integrity and competence, ensuring policy benefits are paid fairly and accurately as per the contract. An incorrect approach that focuses solely on the insured's stated needs without verifying policy coverage fails to uphold the contractual obligations of the insurance policy. This can lead to the insurer paying for expenses that are not covered, creating a financial risk for the insurer and potentially setting a precedent for future claims that deviates from policy terms. This also violates the principle of acting within the scope of the policy agreement. Another incorrect approach that involves delaying payment due to minor ambiguities without seeking clarification or making a good faith determination of coverage is also professionally unacceptable. This can cause undue financial hardship for the insured, potentially violating regulations that mandate prompt payment of covered claims. It demonstrates a lack of diligence and can erode trust between the insured and the insurer. A further incorrect approach that involves making assumptions about coverage based on similar past claims, without a specific review of the current policy and loss details, is risky. Each claim must be evaluated on its own merits based on the specific policy language and facts. This can lead to inconsistent claim handling and potential regulatory scrutiny. For unfair claims practices, professionals should employ a decision-making framework that begins with a clear understanding of the policy contract, specifically the definitions of covered expenses. This should be followed by a meticulous assessment of the claimed expenses against these definitions, considering any applicable endorsements, exclusions, and state-specific regulations. If ambiguity exists, the professional should consult internal guidelines, policy interpretation manual, or seek guidance from supervisors or legal counsel to ensure a fair and compliant resolution. The ultimate goal is to provide accurate coverage determinations and timely payments for all expenses that are contractually obligated. Question 8. The analysis reveals that an insurance underwriter is evaluating a potential policyholder's application for homeowners insurance. The applicant has a history of minor, easily repairable plumbing leaks that have occurred annually for the past 5 years. The underwriter is considering how to classify the risk associated with these past events. Which of the following best represents the definition of risk in this context, according to the principles relevant to the CIC Personal Lines Institute exam? Option A. The potential for a future financial loss arising from an uncertain event, considering both the probability and severity of the loss. Option B. The guaranteed occurrence of significant water damage and associated repair costs based on past minor leaks. Option C. The certainty of future financial loss due to the recurring nature of minor plumbing issues. Option D. The applicant's personal anxiety about potential future plumbing problems. Correct answer is C. The certainty of future financial loss due to the recurring nature of minor plumbing issues. Explanation. This scenario presents a professional challenge because accurately defining and assessing risk is fundamental to the insurance underwriting process, directly impacting policy pricing, coverage terms, and the insurer's financial stability. Misinterpreting or misapplying the definition of risk can lead to adverse selection, inadequate reserves, and noncompliance with regulatory standards designed to protect consumers and ensure market integrity. Careful judgment is required to distinguish between different types of risk and to apply appropriate assessment methodologies. The correct approach involves identifying and evaluating potential future events that could result in financial loss to the insured and, consequently, to the insurer. This aligns with the core principle of insurance, which is to provide financial protection against uncertain future events. Regulatory frameworks, such as those governing the CIC Personal Lines Institute exam, emphasize the need for insurers to understand and manage the risks they underwrite. This understanding is crucial for fair pricing and for ensuring that policies meet the needs of policyholders without exposing the insurer to undue financial strain. An incorrect approach that focuses solely on the certainty of an event occurring fails to grasp the essence of risk in insurance. Insurance is designed to cover uncertain events, not guaranteed losses. Focusing only on the likelihood of an event without considering the potential severity of the financial loss is also an incomplete assessment of risk. Risk is a function of both probability and impact. Another incorrect approach might be to consider only the insured's perception of risk, rather than an objective assessment of potential financial loss. While customer perception is important for sales and service, the underwriting definition of risk is based on quantifiable financial exposure. Professionals should employ a decision-making framework that begins with a clear understanding of the definition of risk as it pertains to insurance. This involves considering both the probability of an event and the potential severity of its financial consequences. They should then apply established underwriting principles and guidelines, referencing relevant regulatory requirements, to assess the specific risks associated with an applicant or policy. Continuous learning and staying abreast of industry, best practices, and regulatory changes are essential for maintaining professional competence in risk assessment. Question 9. Stakeholder feedback indicates that some underwriters are relying heavily on generalized statistical data associated with certain demographic groups when assessing personal auto insurance applications, potentially leading to inconsistent underwriting decisions. An underwriter is reviewing an application for a young driver in a specific urban zip code known to have higher accident rates. The underwriter has access to actuarial data showing a statistically higher claim frequency for young drivers in that zip code. Which of the following approaches best aligns with regulatory requirements for fair and sound underwriting? Option A. Utilize the actuarial data for the zip code and age group to adjust the premium significantly, reflecting the statistical risk, while also considering the applicant's driving record and vehicle type. Option B. Focus solely on the applicant's individual driving record and vehicle type, disregarding the actuarial data for the zip code and age group as potentially discriminatory. Option C. Apply a standard premium for all young drivers in that zip code, assuming the statistical data accurately represents the risk for every individual. Option D. Automatically decline coverage for any applicant who falls within the statistically high-risk demographic and geographic profile, regardless of their individual driving history. The correct answer is A. Utilize the actuarial data for the zip code and age group to adjust the premium significantly, reflecting the statistical risk, while also considering the applicant's driving record and vehicle type. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for accurate risk assessment with the imperative to treat all applicants fairly and avoid discriminatory practices, all within the specific regulatory confines of the CIC Personal Lines Institute exam jurisdiction. The underwriter must navigate potential biases that could arise from relying on broad demographic data versus individual risk factors. The correct approach involves a thorough review of the applicant's specific risk characteristics and verifiable information, aligning with the principle of underwriting based on individual risk rather than protected class status. This is ethically sound and legally compliant with regulations that prohibit unfair discrimination in insurance underwriting. The CIC Personal Lines Institute exam jurisdiction emphasizes that underwriting decisions must be based on objective, quantifiable risk factors directly related to the likelihood and severity of a loss, and not on generalizations about groups of people. An incorrect approach that relies solely on statistical data for a protected class, without considering individual circumstances, fails to meet the regulatory standard for fair underwriting. This can lead to unfair discrimination, where individuals within a group are penalized or charged higher premiums based on characteristics beyond their control and not directly reflective of their personal risk profile. Such an approach violates the spirit and letter of fair insurance practices and can result in regulatory sanctions. Another incorrect approach that involves automatically declining coverage based on broad demographic trends without a detailed individual risk assessment is also professionally unacceptable. This bypasses the core function of underwriting, which is to evaluate each applicant's unique risk. It demonstrates a lack of due diligence and can lead to the denial of coverage to individuals who may actually represent a low risk, thereby failing to serve the market and potentially violating consumer protection laws. Professionals should employ a decision-making framework that prioritizes a comprehensive, individualized risk assessment. This involves gathering all relevant information about the applicant's specific circumstances, applying underwriting guidelines consistently, and ensuring that decisions are justifiable based on objective risk factors. When faced with data that suggests a correlation between a demographic characteristic and risk, the professional judgment must be to investigate if that correlation translates to the individual applicant's specific circumstances, rather than making a blanket assumption. This ensures fairness, compliance, and sound underwriting practice. Question 10. The audit findings indicate that a client wishes to purchase homeowners insurance for a property they do not own, but for which they are paying the mortgage. The client states they want to ensure the property is covered in case of damage, as they are financially responsible for the mortgage payments. Which of the following actions best upholds the principle of insurable interest within the regulatory framework of the CIC Personal Lines Institute exam? Option A. Issue the policy with the client as the named insured, noting their mortgage responsibility in the policy details. Option B. Explain to the client that insurable interest requires a direct financial stake in the property itself, not just responsibility for its financing, and that the property owner should be the named insured. Option C. Suggest the client purchase a collateral protection insurance policy that covers the lender's interest in the property. Option D. Advise the client that since they are responsible for the mortgage payments, they have a sufficient insurable interest to insure the property in their name. The correct answer is D. Advise the client that since they are responsible for the mortgage payments, they have a sufficient insurable interest to insure the property in their name. Explanation. This scenario presents a professional challenge because it requires the agent to navigate a situation where the legal and ethical requirements of insurable interest might conflict with the client's perceived needs or understanding. The agent must apply the principles of insurable interest rigorously to ensure the policy is valid and enforceable, protecting both the client and the insurer from potential future disputes. Careful judgment is required to explain these principles clearly without alienating the client. The correct approach involves identifying that the individual purchasing the policy must have a demonstrable financial stake in the property being insured. This means the policyholder stands to suffer a direct financial loss if the insured property is damaged or destroyed. This aligns with the fundamental principle of insurable interest, which is a cornerstone of insurance law. Without it, a contract of insurance could be construed as a wager, which is not permissible. The regulatory framework for personal lines insurance mandates that an insurable interest must exist at the time of the loss for the policy to be valid. An incorrect approach would be to issue the policy simply because the individual is paying the premium. This fails to recognize that premium payment alone does not create an insurable interest. The regulatory framework requires a financial stake, not just a financial transaction. Issuing a policy without a valid insurable interest can lead to the policy being voided, leaving the insured without coverage and potentially exposing the agent to regulatory sanctions for misrepresentation or failing to adhere to underwriting guidelines. Another incorrect approach would be to advise the individual that they can name anyone as the insured, regardless of their relationship to the property. This disregards the legal requirement for a direct financial interest. Insurable interest is personal to the policyholder and must be tied to the specific property. Failing to adhere to this principle can result in claims being denied and significant legal complications. Finally, an incorrect approach would be to suggest that the individual can purchase the policy and then transfer ownership to the person who actually has an insurable interest. This is a form of misrepresentation and circumvention of underwriting rules. The insurable interest must exist at the inception of the policy and at the time of the loss. Attempting to circumvent this requirement is unethical and violates regulatory principles designed to prevent speculative insurance. The professional decision-making process in such situations should involve 1. Understanding the core principle of insurable interest as defined by the relevant jurisdiction's insurance laws and regulations. 2. Gathering sufficient information from the client to determine if a valid insurable interest exists. 3. Clearly and concisely explaining the concept of insurable interest to the client, using plain language. 4. Advising the client on the correct party to insure the property based on their insurable interest. 5. Documenting all discussions and decisions related to insurable interest. 6. Consulting with underwriting or compliance if there is any ambiguity. Question 11. Risk assessment procedures indicate that a client has submitted an inquiry regarding the status of a recently filed property damage claim. The client is seeking specific details about the adjuster's findings and the estimated timeline for repair authorization. Which of the following represents the most appropriate initial response from the insurance professional? Option A. Acknowledge receipt of the client's inquiry. Confirm that the claim is under review by the insurer, and inform the client that the adjuster's report is being processed, providing an estimated time frame for when the agency will receive an update and can then relay it to the client. Option B. Immediately contact the assigned claims adjuster directly and provide the client with the adjuster's direct contact information, instructing the client to communicate with the adjuster for all claim status updates. Option C. Inform the client that the agency does not have access to specific adjuster findings or repair timelines, and that the client will only be contacted by the insurer when a final decision has been made. Option D. Advise the client that based on similar past claims, repairs are likely to be authorized within the next week, and that the client should expect a settlement offer shortly thereafter. The correct answer is A. Acknowledge receipt of the client's inquiry, confirm that the claim is under review by the insurer, and inform the client that the adjuster's report is being processed, providing an estimated timeframe for when the agency will receive an update and can then relay it to the client. Explanation. This scenario is professionally challenging because it requires the insurance professional to balance the client's immediate need for information with the insurer's established communication protocols and the need for accurate, authorized responses. The professional must act as a conduit of information while adhering to their agency's and the insurer's guidelines, ensuring that client expectations are managed appropriately and that no unauthorized commitments are made. Careful judgment is required to determine the appropriate level of detail and the correct channels for relaying information. The correct approach involves acknowledging the inquiry, confirming receipt of the request, and clearly stating the process for obtaining the requested information, including the expected time frame. This approach is correct because it demonstrates professionalism and responsiveness while respecting the established workflows and communication channels between the agency and the insurer. It aligns with ethical obligations to be truthful and transparent with clients, managing their expectations realistically. Furthermore, it adheres to regulatory guidelines that often mandate clear communication and timely responses, ensuring that clients are not misled or left without a clear path to resolution. An incorrect approach of directly providing the requested information without verification or authorization is professionally unacceptable. This fails to adhere to agency and insurer protocols, potentially leading to the dissemination of inaccurate or incomplete information, which could have significant financial or legal repercussions for the client and the insurer. It also bypasses the established channels for claims handling and information dissemination, which are in place to ensure accuracy and compliance. Another incorrect approach of ignoring the inquiry or delaying a response significantly is also professionally unacceptable. This demonstrates a lack of diligence and poor customer service, potentially violating ethical duties to act in the client's best interest and failing to meet regulatory expectations for timely communication. Such inaction can erode client trust and lead to dissatisfaction, potentially resulting in complaints or regulatory scrutiny. A third incorrect approach of making assumptions or providing speculative information about the claim's outcome is professionally unacceptable. This is unethical as it misrepresents the current status and potential resolution of the claim, creating false hope or undue concern for the client. It also violates the principle of providing accurate information and can lead to significant client dissatisfaction and potential legal issues if the actual outcome differs from the speculative information provided. The professional decision-making process for similar situations should involve 1. Acknowledging the client's inquiry promptly. 2. Identifying the specific information requested. 3. Consulting internal agency procedures and insurer guidelines for handling such inquiries. 4. Communicating the established process and expected timeline to the client, managing their expectations. 5. Escalating or seeking clarification from the insurer as necessary, ensuring all communication is authorized and accurate. Question 12. Stakeholder feedback indicates that policyholders are experiencing confusion and dissatisfaction with how claims for water damage are being handled, particularly when the damage originates from sources not explicitly listed as covered perils. As a licensed agent, what is the most appropriate initial step to address this feedback and ensure compliance with regulatory expectations for personal lines insurance? Option A. Immediately deny the claim, citing the common exclusion for gradual water damage unless specifically endorsed. Option B. Advise the policyholder that all water damage is excluded unless a specific endorsement is purchased. Option C. Conduct a thorough review of the specific policy language, including all endorsements and exclusions, to determine coverage for the reported water damage. Option D. Offer a small ex gratia payment to the policyholder to resolve the issue quickly and avoid further complaints. Correct answer is A. Immediately deny the claim, citing the common exclusion for gradual water damage unless specifically endorsed. Explanation. This scenario is professionally challenging because it requires balancing efficient claims processing with the insurer's obligation to provide accurate and complete information to policyholders regarding their coverage for water damage, a common and often complex peril. The CIC Personal Lines Institute exam jurisdiction emphasizes clear communication and adherence to policy terms and conditions. The correct approach involves a thorough review of the policy to determine if the specific type of water damage is covered, excluded, or subject to specific conditions. This aligns with the regulatory framework's emphasis on fair claims handling and accurate representation of policy benefits. It ensures the policyholder receives a response that is both legally sound and ethically responsible, preventing potential misinterpretations or disputes. An incorrect approach that immediately denies coverage without a detailed policy review fails to uphold the insurer's duty to investigate claims thoroughly. This can lead to allegations of bad faith and violations of fair claims practices regulations, which mandate a reasonable and timely investigation. Another incorrect approach that offers a settlement without a clear explanation of the coverage limitations or exclusions misleads the policyholder and can result in underpayment or denial of legitimate claims. This violates the principle of transparency and can breach regulatory requirements for clear communication regarding policy benefits and limitations. Finally, an incorrect approach that delays the investigation unnecessarily without valid reasons can result in regulatory penalties for slow claims handling and damage to the insurer's reputation. Professionals should employ a decision-making framework that prioritizes understanding the policy, investigating the facts of the loss, communicating clearly with the policyholder, and applying policy terms and conditions fairly and consistently, all within the bounds of applicable regulations. Question 13. Consider a scenario where a prospective client asks an insurance agent, "Do you work for just one company, or can you shop around for the best deal for me?" The agent, who is appointed exclusively by a single insurance carrier to sell its personal line's products, wants to secure the sale. What is the most appropriate and compliant response for the agent to provide? Option A. I can certainly look into different options for you. Let me see what's available. Option B. I represent specific insurance company name and I'm compensated by them to offer their products. I can explain the benefits and features of their policies to help you find the right coverage. Option C. My primary focus is on providing excellent service and finding the best solutions for your needs, regardless of the company. Option D. I have access to a wide range of insurance options and can compare prices from various providers to ensure you get the best value. Correct answer is B. I represent specific insurance company name, and I'm compensated by them to offer their products. I can explain the benefits and features of their policies to help you find the right coverage. Explanation. This scenario is professionally challenging because it requires the agent to balance the immediate need to secure a sale with the long-term implications of misrepresenting the nature of their agency relationship. The agent must understand that their actions can have significant regulatory and ethical consequences, impacting both their own license and the reputation of their insurer. Careful judgment is required to ensure that the client's understanding of the distribution system is accurate, which is fundamental to informed consent and fair dealing. The correct approach involves clearly and accurately explaining that they represent a specific insurance company and are compensated by that company for selling its products. This aligns with the principles of transparency and honesty mandated by insurance regulations. By accurately describing their role as an exclusive agent, the agent upholds their fiduciary duty to the client and the insurer, ensuring compliance with laws that govern agency relationships and prohibit deceptive practices. This approach fosters trust and allows the client to make an informed decision based on a clear understanding of who they are dealing with and how the agent is compensated. An incorrect approach would be to imply they represent multiple companies or have broad market access when they do not. This misrepresentation can lead to regulatory violations, such as engaging in deceptive advertising or unfair trade practices, which can result in fines, license suspension, or revocation. Ethically, it breaches the duty of good faith and fair dealing owed to the client. Another incorrect approach would be to avoid the question or provide vague answers, which, while not an outright lie, can still mislead the client and create a false impression, potentially leading to similar regulatory and ethical breaches. This lack of clarity can be interpreted as an attempt to obscure the agent's true relationship with the insurer. Professionals should employ a decision-making framework that prioritizes accuracy and transparency. When faced with client inquiries about their agency status, professionals should first identify the core of the client's question, which is typically about the range of products and the agent's independence. They should then consult their own agency agreement and company guidelines to ensure their description is factually correct. The next step is to communicate this information clearly and concisely, avoiding jargon and focusing on the client's understanding. If there is any doubt about how to best explain the situation, seeking guidance from their supervisor or compliance department is a prudent professional step. The ultimate goal is to ensure the client feels informed and confident in their decision-making process, which is built on a foundation of truthful representation. Question 14. The efficiency study reveals that a significant number of personal lines claims are being delayed due to minor discrepancies in initial application disclosures. In one instance, A homeowner failed to disclose a small, detached shed on their property that was not the location of the subsequent fire claim. The insured did not consider this shed relevant to their dwelling insurance. However, the insurer's underwriting guidelines technically require all structures to be listed. How should the insurer proceed to uphold the principle of utmost good faith while addressing the disclosure discrepancy? Option A. Issue a partial payment for the claim while reserving the right to investigate the undisclosed shed further, potentially leading to a policy cancellation. Option B. Immediately deny the claim due to the undisclosed structure, citing the breach of disclosure requirements. Option C. Proceed with the claim settlement without mentioning the undisclosed shed to avoid further complications and maintain customer satisfaction. Option D. Contact the insured to understand the reason for the omission, explain the importance of full disclosure, and assess if the undisclosed shed materially impacted the risk or the claim. The correct answer is B. Immediately deny the claim due to the undisclosed structure, citing the breach of disclosure requirements. Explanation: the efficiency study reveals a common challenge in personal lines insurance, balancing the need for prompt claims processing with the fundamental principle of utmost good faith. This scenario is professionally challenging because it requires an insurance professional to navigate the tension between operational speed and the ethical obligation to be completely honest and fair with the insured. The insured's failure to disclose a minor, seemingly irrelevant detail during the application process creates a potential issue that could impact the insurer's risk assessment, even if the detail did not directly contribute to the subsequent claim. Careful judgment is required to determine the appropriate course of action without violating the principles of utmost good faith. The correct approach involves a thorough and transparent investigation into the undisclosed information. This means contacting the insured to understand why the information was omitted and explaining the importance of full disclosure, even for seemingly minor details. The insurer must then assess whether the omission was intentional, negligent, or a genuine oversight, and whether it materially affects the risk. If the omission was not material to the claim or the risk, the policy should generally remain in force. This approach upholds the principle of utmost good faith by treating the insured with fairness and transparency, giving them an opportunity to explain and rectifying any misunderstanding, while also fulfilling the insurer's duty to accurately assess risk. This aligns with the core tenets of insurance contracts, which are founded on trust and mutual disclosure. An incorrect approach would be to immediately deny the claim based solely on the undisclosed information, without further investigation or communication with the insured. This fails to uphold the principle of utmost good faith because it presumes negative intent or material misrepresentation without due diligence. It can be seen as unfair and potentially a breach of the insurer's duty to act honestly and reasonably. Another incorrect approach would be to ignore the undisclosed information and proceed with the claim settlement as if nothing happened. While this might seem expedient, it fails to address a potential breach of the insurance contract and could lead to future complications or legal challenges if the undisclosed information is later discovered to be material. It also undermines the insurer's responsibility to maintain accurate risk profiles. Professionals should employ a decision-making framework that prioritizes transparency, fairness, and thorough investigation. When a potential issue arises regarding disclosure, the first step is to gather all relevant facts. This includes reviewing the policy application, the claim details, and any available information about the undisclosed item. The next step is to communicate with the insured to seek clarification and understand their perspective. This dialogue is crucial for maintaining trust and fulfilling the duty of utmost good faith. Finally, the insurer must make a reasoned decision based on the gathered facts and the insured's explanation, considering whether the omission was material to the risk or the claim, and acting in accordance with the policy terms and regulatory requirements. Question 15. The risk matrix shows a significant increase in potential fire damage claims for homes built with combustible materials compared to those with non-combustible or fire-assistive construction. An agent is reviewing an application for a homeowner's policy for a property built in the 1950s. The applicant states it's a solid house. What is the most appropriate action for the agent to take to ensure accurate construction type classification for underwriting purposes, adhering to the principles of the CIC Personal Lines Institute exam? Option A. Classify the home as joisted masonry based on the era and the applicant's description, as this is a common construction type for homes of that age. Option B. Assign a default rating for older construction that accounts for potential risks without needing specific details on the construction materials. Option C. Assume the home is frame construction, as this is the most prevalent construction type nationwide, and proceed with policy issuance to meet the applicant's timeline. Option D. Request a copy of the original building permits and any subsequent renovation permits, and if unavailable, recommend a physical inspection by a qualified inspector to determine the exact construction type. The correct answer is A. Classify the home as joisted masonry based on the era and the applicant's description, as this is a common construction type for homes of that age. Explanation. This scenario is professionally challenging because accurately classifying construction type for homeowners insurance is fundamental to underwriting, pricing, and claims handling. Misclassification can lead to significant financial losses for the insurer and inadequate coverage for the insured. The CIC Personal Lines Institute exam emphasizes understanding how construction type impacts risk and premium. Professionals must apply regulatory guidelines and ethical principles to ensure fair and accurate policy issuance. The correct approach involves a thorough understanding of construction classifications, as defined by industry standards and regulatory guidance, relevant to the CIC Personal Lines Institute exam jurisdiction. This typically includes distinguishing between frame, joisted masonry, masonry non-combustible, and fire-assistive construction. The insurer's underwriting guidelines, which are informed by these standards and regulatory requirements, must be strictly followed. Accurate classification ensures the premium reflects the actual risk, preventing adverse selection and maintaining solvency. Ethically, it ensures the policyholder is charged a fair premium for the coverage provided, and that the policy will respond appropriately in the event of a covered loss. An incorrect approach of relying solely on the applicant's verbal description without verification is professionally unacceptable. This fails to adhere to underwriting best practices and regulatory expectations for due diligence. It can lead to underpricing the risk, potentially resulting in financial strain on the insurer, and a higher likelihood of claims exceeding collected premiums. Furthermore, it violates the ethical duty to underwrite policies accurately and fairly. Another incorrect approach of assuming a standard construction type based on the age of the home without physical inspection or review of building permits is also flawed. While age can be an indicator, it is not a definitive determinant of construction. Modern building codes and materials may have been used in older homes, or renovations could have altered the original construction. This assumption bypasses the necessary risk assessment process, leading to potential misclassification and its associated financial and ethical implications. A third incorrect approach of prioritizing speed of policy issuance over accurate risk assessment is a direct violation of underwriting principles and regulatory oversight. While efficiency is valued, it must not compromise the integrity of the underwriting process. Regulatory frameworks for personal lines insurance mandate accurate risk assessment to protect both the insurer and the consumer. Failing to conduct a proper assessment due to time constraints is an ethical lapse and a potential regulatory violation. The professional decision-making process for similar situations should involve a structured approach. 1. Understand and apply the definitions of construction types as per industry standards and relevant regulatory guidelines. 2. Utilize all available information sources, including applicant statements, property inspection reports, building permits, and insurer-specific underwriting manuals. 3. Prioritize accuracy and completeness in risk assessment over speed. 4. Document all findings and decisions thoroughly. 5. Consult with underwriting supervisors or subject matter experts when uncertainty exists. 6. Adhere to the insurer's underwriting guidelines and all applicable laws and regulations. Question 16. The performance metrics show a significant number of clients requesting the lowest premium option for their homeowner's insurance, even when their stated property values and risk factors suggest a higher level of coverage is advisable. An agent is presented with a client who explicitly requests the most basic, least expensive homeowner's policy available, stating they are on a very tight budget and cannot afford more. Despite owning a home valued at $400,000 with a detached garage and a swimming pool, which of the following approaches best aligns with legal and ethical considerations for this agent? Option A. Advise the client that the basic policy is insufficient and refuse to issue it, insisting they purchase a more expensive, comprehensive policy. Option B. Explain to the client the potential financial risks and coverage gaps associated with the basic policy given their property's value and features, and recommend a policy that provides more adequate protection, discussing options for managing the premium if necessary. Option C. Issue the basic, least expensive policy as requested by the client, noting their budget constraints in the file. Option D. Recommend a policy with a very high deductible to lower the premium, without fully explaining the implications of such a high deductible for the client's out-of-pocket expenses in case of a claim. The correct answer is C. Issue the basic, least expensive policy as requested by the client, noting their budget constraints in the file. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the client's immediate financial concerns with the long-term implications of inadequate coverage, all while adhering to legal and ethical obligations. The agent must act in the client's best interest, which includes providing accurate information and recommending appropriate coverage, even if it means a higher premium. The agent's duty of care and fiduciary responsibility are paramount. The correct approach involves clearly explaining the limitations of the proposed coverage, highlighting the potential financial risks to the client, and recommending the appropriate level of coverage based on the client's stated needs and property value. This aligns with the ethical principle of acting in the client's best interest and the legal requirement to provide accurate and complete information. Regulatory frameworks, such as those governing insurance sales practices, mandate that agents do not misrepresent policy coverage or omit material facts that could lead to underinsurance. Providing a policy that is clearly insufficient for the client's stated needs, even if requested due to cost, could be construed as a violation of these duties. An incorrect approach would be to simply accept the client's request for the cheapest option without fully explaining the risks. This fails to uphold the agent's duty of care and could lead to a significant financial loss for the client in the event of a claim. Ethically, it prioritizes the agent's potential commission or ease of sale over the client's well-being. Legally, it could be seen as a misrepresentation of coverage or a failure to advise properly, potentially exposing the agent and their agency to liability. Another incorrect approach would be to pressure the client into purchasing a more expensive policy than they can afford. While the agent has a duty to recommend adequate coverage, coercion or undue influence is unethical and can also lead to regulatory scrutiny. The agent must find a balance, explaining the risks and options clearly, and allowing the client to make an informed decision within their financial constraints, potentially exploring alternative coverage options or deductibles if available and appropriate. The professional decision-making process for similar situations should involve 1. Thoroughly understanding the client's needs and risk profile. 2. Clearly explaining the coverage provided by different policy options, including limitations and exclusions. 3. Quantifying the potential financial exposure the client faces with inadequate coverage. 4. Recommending the most suitable coverage based on the client's needs and risk tolerance, while also considering their budget. 5. Documenting all conversations and recommendations, ensuring the client understands the coverage they are purchasing. Question 17. The monitoring system demonstrates that the agency's website is ranking highly for search terms related to guaranteed cheap car insurance and instant full coverage, no questions asked. However, the actual personal lines auto policies offered have specific underwriting criteria and do not guarantee the lowest price or offer coverage without any underwriting questions. Which of the following SEO approaches best aligns with regulatory compliance and ethical advertising practices for personal lines insurance? Option A. Adjust the website content and meta descriptions to accurately reflect the available coverage options and pricing structures, using keywords that genuinely describe the agency's offerings, such as affordable auto insurance options or comprehensive car insurance quotes. Option B. Continue optimizing for these high-ranking keywords as they are driving significant traffic, and address specific policy details only if a client inquires directly. Option C. Implement a disclaimer on the website stating that prices and coverage may vary, without changing the primary keywords or website content that attracts users searching for guaranteed cheap or no questions asked insurance. Option D. Focus solely on technical SEO elements like site speed and mobile friendliness, assuming that the current keyword rankings will naturally attract clients who will then discover the actual policy details. Correct answer is B. Continue optimizing for these high-ranking keywords, as they are driving significant traffic, and address specific policy details only if a client inquires directly. Explanation. This scenario is professionally challenging because it requires balancing the desire to attract new clients through digital marketing with the strict regulatory requirements governing insurance advertising and consumer protection. Misrepresenting services or making unsubstantiated claims, even unintentionally through SEO efforts, can lead to significant penalties, reputational damage, and loss of consumer trust. Careful judgment is required to ensure that all online content, including that optimized for search engines, is accurate, not misleading, and compliant with the CIC Personal Lines Institute exam's specified regulatory framework. The correct approach involves focusing on transparent and accurate keyword selection and content creation that reflects the actual personal lines insurance products and services offered by the agency. This means using keywords that genuinely describe the policies, coverage options, and benefits, and ensuring that the website content associated with these keywords is truthful and comprehensive. This approach aligns with regulatory principles that prohibit deceptive advertising and mandate clear communication of policy terms and conditions. By prioritizing accuracy and transparency in SEO, the agency upholds its ethical obligations and avoids potential regulatory violations. An incorrect approach that focuses on using vague or exaggerated keywords to attract a wider audience without accurately reflecting the products is professionally unacceptable. This can be considered misleading advertising, as it creates an expectation in potential clients that may not be met by the actual insurance offerings. Such practices violate regulations designed to protect consumers from being misled about their insurance coverage. Another incorrect approach that prioritizes keyword stuffing or manipulative SEO tactics, such as using irrelevant but highly searched terms, is also professionally unacceptable. This not only degrades the user experience, but can also be interpreted as an attempt to deceive search engines and consumers, leading to potential penalties and a loss of credibility. A further incorrect approach that involves making unsubstantiated claims or guarantees about policy performance or cost savings in website content optimized for search engines is a direct violation of advertising regulations. Insurance products are complex, and promises of guaranteed outcomes without proper qualification or disclosure are inherently misleading and unethical. The professional reasoning process for similar situations should involve a thorough understanding of the applicable regulatory framework, including advertising standards and consumer protection laws. Before implementing any SEO strategy, professionals should conduct a content audit to ensure all website copy is accurate and compliant. They should also regularly review search engine rankings and website traffic to identify any potential issues arising from their SEO efforts. When in doubt, consulting with legal or compliance experts is crucial to ensure adherence to all regulations and ethical standards. Question 18. Market research demonstrates that many consumers prioritize lower premiums when purchasing personal lines insurance. An agent is meeting with a client who is seeking to purchase an umbrella liability policy. The client explicitly states they want the least expensive option available, citing budget constraints. The agent has identified that the client's assets and potential liabilities suggest a higher level of coverage than the lowest cost option would provide. Which of the following actions best demonstrates the agent acting in the client's best interest? Option A. Explaining the potential risks of underinsurance given the client's asset and liability profile, presenting a range of suitable coverage options with clear explanations of their benefits and costs, and then recommending the option that provides the most appropriate balance of protection and affordability for the client's specific situation. Option B. Suggesting the client forego umbrella liability coverage entirely, as it is an optional add-on to save money. Option C. Insisting that the client purchase a higher premium policy, arguing that it is the only responsible choice, and refusing to offer any less expensive alternatives. Option D. Recommending the least expensive umbrella liability policy to meet the client's stated preference for a lower premium, without further discussion. The correct answer is D. Recommending the least expensive umbrella liability policy to meet the client's stated preference for a lower premium, without further discussion. Explanation. This scenario is professionally challenging because it requires the agent to balance the client's stated preferences with their own professional judgment and fiduciary duty. The agent must recognize that a client's initial request might not fully align with their actual needs or the most suitable coverage available, especially when dealing with complex personal lines products like umbrella liability. The core of the challenge lies in the agent's obligation to act in the client's best interest, which supersedes simply fulfilling a direct request if that request could lead to inadequate protection or financial detriment. Careful judgment is required to navigate this delicate balance, ensuring transparency and client education without being overly persuasive or dismissive of the client's input. The correct approach involves a thorough needs analysis, active listening, and providing informed recommendations. This approach prioritizes understanding the client's unique circumstances, risk tolerance, and financial situation. By asking probing questions about assets, lifestyle, and potential liabilities, the agent can accurately assess the client's true insurance needs. Presenting multiple coverage options with clear explanations of benefits, limitations, and costs, and then recommending the option that best aligns with the client's overall best interest, demonstrates adherence to the fiduciary duty and regulatory requirements to act in good faith and with due diligence. This aligns with the principles of client-centric service and the ethical imperative to provide advice that serves the client's welfare. An incorrect approach would be to simply process the client's request for the lowest premium without further inquiry. This fails to uphold the agent's duty to assess the client's needs adequately and could result in underinsurance, leaving the client exposed to significant financial risk. Ethically, this is a dereliction of duty. Another incorrect approach would be to dismiss the client's concerns about cost and insist on a higher premium policy without fully exploring alternative solutions or explaining the value proposition of the more expensive option. This could be perceived as pushy sales tactics and may not be in the client's best financial interest if a more affordable, yet still adequate solution exists. It also fails to respect the client's financial constraints. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's stated needs and concerns. Begin by actively listening to the client's initial request and any expressed concerns, such as budget limitations. 2. Conduct a comprehensive needs analysis. Go beyond the stated request to gather information about the client's assets, liabilities, lifestyle, and risk tolerance through targeted questioning. 3. Educate and inform. Clearly explain the purpose and benefits of different coverage levels and types of insurance, as well as the potential consequences of inadequate coverage. 4. Present tailored options. Offer a range of suitable policy options that address the identified needs, detailing the pros and cons of each, including cost. 5. Make a recommendation. Based on the analysis and client discussion, recommend the option that best serves the client's overall best interest, justifying the recommendation. 6. Document the process. Maintain thorough records of the client's needs, the options discussed, the client's final decision, and the rationale behind the recommendation. Question 19. Quality control measures reveal that an agent consistently obtains credit reports for personal auto insurance applicants without explicitly informing them or obtaining their written consent prior to the inquiry. The agent believes this is standard practice and speeds up the underwriting process. Which of the following actions should the agency take to ensure compliance with regulatory and ethical standards? Option A. Immediately cease the practice of obtaining credit reports without prior applicant consent and implement mandatory training for all agents on the proper procedures for requesting and using credit information, including obtaining explicit consent. Option B. Continue the current practice but instruct agents to verbally inform applicants about the credit report inquiry during the application process, without requiring written consent. Option C. Advise agents to only use credit reports when absolutely necessary for high-risk applicants, and to document the rationale for each inquiry without seeking explicit consent. Option D. Rely solely on the information provided by the applicant on the application form, and discontinue the use of credit reports altogether for personal auto insurance underwriting. The correct answer is A. Immediately cease the practice of obtaining credit reports without prior applicant consent and implement mandatory training for all agents on the proper procedures for requesting and using credit information, including obtaining explicit consent. Explanation. This scenario presents a professional challenge because it involves balancing the need for accurate underwriting information with the applicant's right to privacy and the potential for discriminatory practices. The CIC Personal Lines Institute exam emphasizes the importance of ethical information gathering and adherence to regulatory guidelines designed to protect consumers. Careful judgment is required to ensure that all necessary information is obtained without violating these principles. The correct approach involves obtaining the applicant's explicit consent before requesting a credit report. This aligns with regulatory frameworks that govern the use of consumer credit information for insurance underwriting. Specifically, laws such as the Fair Credit Reporting Act, FCRA, in the United States require that consumers be informed and provide consent before their credit information is accessed for such purposes. Ethically, this demonstrates transparency and respect for the applicant's privacy. An incorrect approach would be to obtain the credit report without informing the applicant or securing their consent. This directly violates consumer protection laws and ethical standards. Such an action could lead to regulatory penalties, damage the insurer's reputation, and erode consumer trust. It also opens the door to potential allegations of unfair or discriminatory practices if the credit information is used inappropriately. Another incorrect approach would be to rely solely on information provided by the applicant without any independent verification, such as an inspection or credit report, when such verification is standard practice for the type of risk being underwritten. While consent is crucial for credit reports, insurers have a responsibility to underwrite risks accurately. Failing to gather necessary information, even if it means not using a credit report, can lead to adverse selection and financial losses for the insurer, and potentially inadequate coverage or unfair pricing for the insured. The professional decision-making process for similar situations should begin with understanding the specific regulatory requirements for information gathering in the relevant jurisdiction. This includes identifying what types of information can be collected, under what conditions, and what disclosures and consents are necessary. Insurers must then implement clear internal policies and procedures that guide their agents and underwriters in adhering to these regulations and ethical best practices. When in doubt, consulting with legal counsel or compliance officers is essential to ensure all actions are compliant and ethical. Question 20. Compliance review shows that an insurance agent is assisting a client in purchasing a new home in a coastal area. The agent knows that flood insurance is often a critical consideration in such locations, but the client has not explicitly asked about it. The agent is unsure whether to proactively investigate the property's flood zone status and explain NFIP coverage, or to wait for the client to inquire. Option A. Proactively determine the property's flood zone designation using FEMA resources and explain the implications of the National Flood Insurance Program, NFIP, coverage to the client, including any mandatory purchase requirements and policy limitations. Option B. Assume the client is aware of flood risks and NFIP coverage since they are purchasing a home in a coastal area, and wait for them to ask specific questions about flood insurance. Option C. Advise the client that flood insurance is generally expensive and often has significant exclusions, suggesting they might want to consider the cost-benefit before purchasing, without verifying the flood zone. Option D. Focus on securing homeowners insurance coverage and only discuss flood insurance if the client specifically requests information about it, without independently verifying the property's flood zone. The correct answer is A. Proactively determine the property's flood zone designation using FEMA resources and explain the implications of the National Flood Insurance Program, NFIP, coverage to the client, including any mandatory purchase requirements and policy limitations. Explanation. Scenario analysis. This scenario presents a common challenge for insurance agents, balancing client needs with the strict requirements of a government-mandated program like the National Flood Insurance Program, NFIP. The agent must navigate the complexities of NFIP eligibility, coverage limitations, and disclosure obligations, all while ensuring the client understands their policy. The professional challenge lies in accurately identifying the property's flood zone designation and its implications for coverage, as misrepresentation or omission can lead to significant financial and legal repercussions for both the agent and the insured. Correct approach analysis. The correct approach involves diligently verifying the property's flood zone designation using official FEMA resources, and then clearly communicating the implications of that designation to the client. This aligns with the agent's duty of care and regulatory requirements to provide accurate information. Specifically, the agent must consult the flood insurance rate map, FIRM, to determine the property's flood zone. If the property is in a special flood hazard area, SFHA, the agent must explain that flood insurance is mandatory for properties with federally backed mortgages and that the NFIP policy has specific limitations and exclusions. This proactive verification and clear communication ensure the client makes an informed decision and that the agent fulfills their obligation to represent the NFIP accurately. Incorrect approaches analysis. An approach that assumes the client's existing knowledge of flood risk or coverage is incorrect because it abdicates the agent's responsibility to inform. Agents are expected to be knowledgeable about the products they sell and to proactively educate their clients, especially concerning government programs with specific rules. Relying on the client's presumed understanding is a failure to meet the duty of care and can lead to misrepresentation. An approach that focuses solely on selling the policy without verifying the flood zone designation is also incorrect. This bypasses a critical step in the NFIP underwriting process and could result in the issuance of a policy that does not accurately reflect the property's risk or the client's actual coverage needs. This is a violation of regulatory requirements for accurate risk assessment and disclosure. An approach that downplays the significance of the flood zone designation or the limitations of NFIP coverage to secure a sale is unethical and a violation of regulatory guidelines. Agents must provide truthful and complete information about policy terms, conditions, and limitations. Misleading clients about flood risk or coverage is a form of misrepresentation and can lead to severe penalties. Professional reasoning. Professionals should adopt a systematic approach when dealing with NFIP policies. First, always verify the property's flood zone designation using official FEMA resources. Second, clearly and comprehensively explain the implications of that designation, including mandatory purchase requirements, if applicable, coverage limits, deductibles, and exclusions. Third, ensure the client understands this information and has the opportunity to ask questions. Document all communications and advice provided to the client. This methodical process ensures compliance, protects the client, and upholds professional integrity.